Welcome to Early Edge Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So today we are going to take a deep dive into Ramco Systems Ltd. So it is a part of the Ramco Group. It provides multi-tenant cloud and mobile-based enterprise software solutions in the area of customized global payroll, ERP, logistics, and many MRO for aviation, SRP, and enterprise asset management services. Also, it has expertise in catering to the aviation sector, has forayed into the US defense sector. Now, the company helps organizations stay agile and connected by delivering enterprise-wide transformation, real-time visibility across operations, faster go-to-market for new offerings, superior user experiences to boost engagement, and intelligent connected ecosystems of customers, partners, and employees, and API-enabled integrated to unlock new revenue streams. Also, adding to this, they have reduced their IT spend through automation and optimization. So coming to their revenue breakup, so around 38% of the revenue comes from global payroll and HR, 27% from ERP, and 35% from aviation. So they're quite diversified in this three segment. Geography-wise revenue segmentation is as follows. So the Asia Pacific region contributes around 42% of the revenue, 20% comes from India, 23% comes from US, 4% from Europe, and 11% from the MENA region. Now, some of the new innovations of Ramco across their business segments is as follows. So they recently launched the Ramco Aviation Tech, which places predictive maintenance, AI-driven planning, and intuitive workflow orchestration at the core of operational transformation. Also, they've enhanced their engine capabilities with smart diagnostics, automated working scope, and improve lifecycle traceability. And they've also integrated generative AI into their core aviation operations to enable smart documentation, conversational maintenance interface, and contextual decision support. Now, in the logistics segment, they have re-engineered the WMS, which is warehouse management systems, to deliver greater scalability, performance, and user-centric design. They've transitioned towards low-code platforms, enabling faster customization and reducing reliance on the manual processes. Also, they've strengthened their last-mile logistics and cold chain capabilities to support new logistics verticals. Coming to the ERP segment, they've introduced role-based dashboards and conversational ERP capabilities, allowing users to initiate and complete transactions via voice or chats. They've recently launched a business intelligence platform called Bingo, which is business intelligence on the go, featuring 50 plus pre-built dashboards for on-demand analytics and real-time operational insights, which is quite innovative. Also, they've deployed self-service configuration tools for workflow notifications, alerts, and reducing IT dependency and enabling faster process customization. In the payroll segment, they recently launched Ramco Pace, a software as a service-based payroll platform, which went operational in Australia, Japan, and Southeast Asia. And it is empowered by advanced AI capabilities, and the platform automates compliance, fosters meaningful employee interaction, and enriches decision-making across complex global payroll landscapes. Now, looking forward, so they have given guidance on the following strategies for sustainable growth. So they believe that their value creation hinges on three strategic imperatives, which is modernization, market expansion, and execution excellence. So in the modernization and product innovation segment, they plan to continue investment in machine learning, low-code frameworks, self-service tools. They're also focusing on new product lines which feature smarter interfaces, conversational workflows, and automation at scale. Their ERP and logistic platforms have been comprehensively re-architectured to reduce manual interventions and accelerate deployment timelines. And the aviation suite has been enhanced with predictive diagnostics, digital twin technology, and generative AI for intelligent MRO operations. So also they're focused on market expansion. They want to double down on high growth regions like India, the Middle East, and Southeast Asia and Australia. They're broadening their reach into adjacent segments like cold chain logistics and defense MRO. Also, they're strengthening their go-to-market momentum through strategic alliances with local partners, active engagement with regional industry bodies. Now, the third imperative revolves around execution excellence and profitability. Improved implementation cycles with faster rollouts and strengthened governance programs is their key focus. And they are also focused on deepening the customer retention, driving reference-led growth, and expanding cross-selling opportunities across business units. They have maintained financial discipline through a lean cost structure, robust deal qualification, and careful capital allocation. Coming to the industry analysis, so there is high tailwinds in aviation tech MRO due to growing demand for predictive maintenance, mobile first applications, and Gen AI for aircraft lifecycle optimization. Also, companies having cross-border workforce are driving demand for unified payroll systems with automation and compliance, which the company provides. Also, the enterprises are migrating from legacy systems towards digital first AI integrated cloud solutions, and there is exploding need for intelligence, self-learning enterprise systems in a post-COVID cost-optimized landscape. And due to the disruption-led digitization, there is also rising requirement for scalable warehouse management and transport management systems with rapid deployment and paperless. So in all these segments, Ramco emerges as a very good player. The future outlook is guided by the management as follows. Now, we have already discussed that they have plans to expand in high traction geographics. Also, they plan to deepen the adoption of Ramco Aviation 6.0 and enhance the engine MRO. And also, they plan to scale Ramco Pace. Now, they're focusing on modernizing ERP and logistics with low code and conversational UI and intelligence automation. Also, they're leveraging accelerators and reusable modules and are focusing on continuous innovation and continuous deployment for enhanced delivery quality. And they're focusing on faster implementation, targeting 4 to 5 months and tighter execution benchmarks. Now, their 4 to 5 months target is quite an upgrade because priorly they having delivery times around 12 to 18. So that's a huge up that. Coming to the bull case scenario, so Ramco Aviation 6.0 can become a market leader in the next gen MRO tech with AI and Gen AI integration. As Ramco base scales across large companies, it would boost Ramco's brand recognition and revenue. Also, platform modernization, faster client wins, and improved net retention. And geographical expansion would also yield pipeline with local delivery excellence. The company has got a strategic focus, AI first, low code, and vertical depth, which also drives competitive differentiation for the company. And it has got a order book of 166 million US dollars, which is close to around 1400 crores in Indian rupees, which provides future growth visibility. Adding to that, 60% of their current revenue is recurring in nature, so which makes their projected revenue to around probably 1700 crores. Coming to the bear case scenario, intense competition, global software as a service majors in payroll, ERP, and MRO would limit their market share expansion. Enterprise sales cycles due to disruptions can slow down revenue realization despite in a strong order book. Military shifts or data localization laws, which is quite in discussion nowadays, could hamper multi-country deployments for the company. Profitability would continue to remain volatile if the operational efficiency was scaled with the top line, which is a concern for the company since it's still a loss. However, the company has turned EBITDA positive this year. While recurring revenues are rising, increasing investments could further impact EBITDA margin recovery. So that's a concern. Now, to the 20-factor scorecard. So, recent fundraise was a 120 crore preference issue and 40 crore warrant issue, which was happened in 2023. So the preference issue the warrant was at a premium compared to the market price, which is quite good. And it was at a of around 5%. And the warrant which was issued in 2023 was 40 crores to promoters, converted 2024, rather a great news. But however, the entire fundraise was most of it was utilized for repayment of borrowings and spent a limited portion of 10 crores on sales and marketing expenses, 20 crores on capex towards tangible and intangible assets, and 32.5 crores for general corporate purposes. Since the fundraise was for repayment of borrowings, so I gave them a 3 here. Regarding direct promoter track record, they've got experienced personnel, and Ramco Group holds around 53% of the company. So I gave them a 5 here. Regarding related party transactions, they have a lot of purchase and sales transactions with subsidiaries, and they also have income from royalty from the subsidiaries. Nothing big enough to raise a red flag. However, 60% of the sales and 16% of the purchases are from related parties or subsidiaries. So in account of that, going to specifically rate them a 3 out of 5 here. Regarding board independence and composition, they've got 8 directors, out of which 4 are independent directors, and they have 2 family on board. So that's decent, good enough. I'm going to give them a 5 here. Regarding CEO and key manager personal salary, so Mr. Subramaniam, salary of around 6.4 crores, which is 1% of sales. And Mr. Chandan, who is the CFO, has a salary of 1.7 crores, which is 0.3% of sales. So it's on the higher side. So I'm going to give them a 3 here. Now, coming to the resignation, the CEO, Mr. Subramaniam, resigned in 2025, despite having a 101% hike in salary since last year. So that's very concerning for the company. Also, their company secretary and compliance officer resigned in 2024 due to personal reasons. And the previous year in 2023, the president and SBU head of ERP, SRP, and logistics resigned. So on account of that, I'm going to rate them a 0 out of 5 here. Coming to auditor resignation or change, the auditor has the tenure till 2027 and they're serving second term. So I'm going to give them a 5 here. Regarding opinion or credit rating opinion, so auditor opinion has been modified for the past years, and credit opinion has also been decent. However, the credit rating agency has downgraded the rating from ICRA A in long term to ICRA BBB plus, and in short term from ICRA E2 plus to ICRA E2. That's a bit concerning. However, since their opinion has unmodified, I'm going to give them a 5 here. They do not have any legal issue against them. However, regarding the promoter group, there are certain active reviews on the internet. Still, I'm going to give them a 5 here, since the company is clean. Also, regarding investigation disclosures, so they disclose their press releases actively. They don't do calls. Their last con call was last year, and they update their results quarterly. So I'm going to give them a 3 out of 5. Coming to the business operations, so we have already discussed their geographical breakup and the segment breakup, so they're quite diversified. They're present in 50 plus customers, and they've got a dynamic and diverse client base across all industries and markets. Their business partners include Workday, KPMG, Microsoft, Honeywell, AWS, TCS, Infosys, and Tech. So on account of this, I'm going to give them a 5 here. CFO by EBITDA. So this year, the CFO EBITDA is quite good. It happened because of improved CFOs. Previous 2 years, it isn't because the company was negative. It was making it was negative. That's why. So I'm going to give them a 3 here. Revenue growth by receivables has been quite good. The company significantly reduced the receivables over the past few years, and the revenue as a percentage of receivables as a percentage is 15% now, which was 30 years back. So that's quite some improvement. So I'm going to give them a 5 here. DSO is quite good as compared to the past 4 years. They have up their DSO since March 2022. So I'm going to give them a 5 here. Same has been noticed in the cash conversion cycle. It came down from 77 in March 2022 to 12 in March 2025. So I'm going to give them a 5 here. Regarding CapEx versus revenue, so CapEx as a percentage of revenue is 13.5%. So they're actively doing CapEx. Also, fixed asset turnover is 1 and asset turnover is 0.9. However, since return on invested capital is a negative for the past 4 years, so I'm going to give them a 3 here. Regarding debt and interest coverage, debt to equity ratio is decent. However, interest coverage is in negative because the company is not earnings are in negative. So I'm going to give them a 3 here. Liquidity position is decent. However, considering the fact that the interest coverage is in negative, so having low liquidity position might affect the company considering if they have any interest applications. So it's draining them basically. So I'm going to give them a 3 out of 5. Regarding ROCE, ROE, and ROA, all the numbers are in negative. They have reduced the negativity have been reduced. They plan to do or make it positive. However, since all the numbers are negative, I'm going to give 0 here. Regarding growth consistency, so revenue has been growing since the past 2 years. Where profit also, PAT also showed a significant growth since. However, it's still negative. So number 3. This makes a total score governance and pointer behavior 37 out of 50, and in financial health 55 out of 50, making the total score 72 out of 100. Now coming to the valuation analysis.
So basically, one of the reasons why the score is extremely low is because the company is in the turnaround phase and our scorecard generally doesn't capture, is backward looking, and it becomes very difficult to capture the turnaround. If you are following Ramco Systems, we are managed promoter score was also pulled down because of CEO resignation and a few other factors. But if you are tracking Ramco Systems and would want to know a good entry point, you have to go and dig deeper into their annual report, etc., and not bank on our scorecard because ours is more backward looking, so more suitable for stable companies. But again, even smart analysis tool would be very difficult to give a projection for 1 year forward as well. But however, let's see what number it is showing. Let's be conservative and give 595 no growth rate. And they have done, since the management is not giving any con call or anything, like very difficult to put a number. But for if March 25, the operating margin was 26%. Hopefully, some rationalization is going in the business. If you see, the expenses have been constantly coming down. So I hope this trend continues because that's very important. And around 20% is the minimum that any IT company has as their total expenses. So if they continue doing that, again, a PE of 30, whatever the stock price comes to 86 again, it becomes extremely difficult to put a number, right? So I would not give any inputs when it comes to this because a lot of turnaround is happening, but they are a lot of improvement in the business is quite evident and visible. The stock is trading at 389 current. And if growth kicks in, so growth was missing last 3 quarters, growth, there's some growth visible as well. Like they've been growing 12, 22, 18% on 3 quarter basis. And that's how this company came into our screen. If we have a slightly longer time frame, this is considering the, what do I say, free cash flow. But let's just take the operating cash flow. Even operating cash flow, they have been doing 100 crores last 2 years. So let's just try keying in 75 after the capex. Even the capex should come down. And required rate of return as 25. 3 years, 3 terminal growth rate as 3. And our holding period as 5 and terminal 5-year multiple of 20. So the company has to grow at 17, 18% for to justify the current price. Again, a lot of assumptions have gone through when I'm keying the earnings number. So keep that as caveat. I would not hurry, but again, track it for 1 or 2 quarters before taking a call. And if the trend of growing at 18%, 20% continues, then I would make a judgment call. Also, I'll be going line by line into their annual report to understand what they're doing and the products are. The annual report is quite detailed. Any final thoughts?
Yeah, same as yours. It's a company worth tracking. So once the company shows promising numbers or the management comes up with a con call or something like that, so that would be a very pivotal for the company.
I hope you found this framework useful. If you follow this company, or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-sector scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research plus cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.